In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and review then rate the company. Today we are going to look at Alphabet, otherwise known as Google. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics achieve or exceed a specific target. Companies can earn 1 point for fully meeting the target or 0.5 points for coming within 2% below the target. The first pillar is earnings per share growth. This is where we take the net income and divide it by the shares outstanding. For Alphabet, earnings per share growth over the past 12 months is 36%, exceeding the 10% target, scoring 1 point. Next, let's look at free cash flow growth, which measures the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health and prefers companies that can generate substantial free cash flow. Alphabet's free cash flow growth is 5%, not quite meeting the target, scoring 0 points. Next, we come to revenue growth, which tells us how good the company is at generating income before deducting expenses. Alphabet's revenue growth is 14%, exceeding the 10% target, scoring 1 point. Now let's turn to book value growth, calculated by subtracting total liabilities from total assets to indicate equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. Alphabet's book value growth is 15%, exceeding the 10% target, scoring 1 point. We then assess the management of the business by looking at return on invested capital and return on equity. These measures allow us to evaluate a company's efficiency at allocating capital. For Alphabet, return on invested capital is 29%, and return on equity is 31%, both far exceeding the 10% target, scoring 1 point for each. Now we move on to debt. Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow within 3 years. Alphabet's debt would take 0.31 years to pay off, which is well below the target and earns 1 point. With the information we have gathered, it tells us that aspects of the key pillars are solid, but let's explore the company further. Now let's look at the remaining key pillars which help define an excellent business. Let's look at the gross margin, which indicates how much money a company retains after incurring the direct costs of producing its goods or services. This is currently at 58%, exceeding the 40% target, scoring 1 point. Next, we come to the operating profit margin, which tells us how much profit a company makes on $1 of sales after production costs but before interest or tax. Peter Lynch prefers companies with strong operating margins when assessing their financial health and competitive advantage. Alphabet's operating profit margin is 32%, far exceeding the target, scoring 1 point. Free cash flow yield provides a more realistic view of a business's financial health. Terry Smith prefers companies with a free cash flow yield of 5% or higher. Alphabet's free cash flow yield is 3.53%, falling below the target, but scoring 0.5 points. Next, we assess the 10-year book value growth as potential shareholders. For Alphabet, this is 13%, exceeding the 10% target, scoring 1 point. Lastly, Bill Miller believes earnings growth is the biggest indicator of a company's stock price. Alphabet's 5-year net income growth is 24%, exceeding the 10% target, scoring 1 point. In the description, I've included a link to the investors page and the annual report if you want to check it out for yourself. Alphabet has demonstrated strong fundamentals in key areas, including revenue growth, return on capital, and operating profit margins. The company also has a low debt burden, which further strengthens its financial position. As of today, the stock is trading at $165.49. Over the past year, Alphabet's stock price has steadily increased, supported by strong financial performance and expansion into new technology markets, and has grown 18%, but has had some dips in September 2024, and is currently in a dip now. Looking at the overview, we can see the current market cap is approximately $2.02 trillion. They are currently generating $350 billion in revenue for the trailing 12 months, and have 12.19 billion shares outstanding. At present, their earnings per share tell us that for each share of stock, the company is generating $8.04. Their price-to-earnings ratio is 20.57, which is below than the S&P 500 average of 28.17. According to Morningstar, Alphabet has a wide economic moat due to its dominance in search, advertising, and cloud computing. The overall consensus among analysts is a buy, with a 12-month price target of approximately $213. Analysts are forecasting an average EPS growth rate of 15% over the next 5 years. Let's calculate a valuation. I will use Alphabet's current earnings per share of $8.04. Combining historical growth rates and future analyst predictions, I estimate an earnings per share growth of 13%. Assigning a forward price to earnings ratio of 32, projecting 10 years forward, and applying a desired return rate of 15%, this results in a future stock price of about $873. The current intrinsic value is about $216, with a margin of safety at $161.91. Since the current price of $165.49 is close to the margin of safety, this scores a check. It all depends on your personal view and outlook for the company, as well as the return on the investment you would like to see. When reviewing the key pillars, Alphabet scored 10.5 out of 12, earning a check. Over the last 6 months, the stock has experienced strong upward momentum, supported by demand for AI and cloud computing, scoring a check. Analysts are predicting a growth rate of 15%, scoring a check. The current price matches the margin of safety price, signaling a check. According to Morningstar, Alphabet has a wide economic moat, which scores a check. My final overall rating is 5 out of 5 stars. Alphabet presents strong financial performance, excellent growth potential, and a strong competitive advantage. And for full disclosure, this is a company I own. Thank you for joining me in today's analysis. Don't forget to like and subscribe for more insights.